Hello, this is Paul Gibson with the Academy of Trading and Investing. We're here today to talk about concepts from the book Notes from a Profitable Investor. Today we'll be talking about Chapter 9. In other words, calculating options profits. Hopefully you have reviewed intently the concepts from the previous chapter, or Chapter 8, that gave you great insights into the concepts of how options work. Now we're going to understand how to calculate the profits and begin to understand how to choose the correct strike prices to maximize our profits. So here's an options chart, sometimes called an option chain. This is from Chicago Board Option Exchange. We can see the strikes are listed in the middle with their expiration dates. As you know, you can look up different expiration dates. The longer the expiration date, by the way, the greater the premium will be. So this is an older chart, but the concept is still well demonstrated. We have the bid price, the ask price with their size. We also have volume here. I would suggest that as you look at volume, if it's zero volume, you'll probably not get involved because you won't be able to transact. It means there's nobody at the other end that will take advantage of your purchase of the contract. Then of course over here we have calls, and over here we have puts. This is a typical option chart. Now each broker or reporting facility will have a different way of presenting these. I like this one pretty much. There are others out there where you can actually get the Greek designations, which we'll talk about in a different chapter. The Greek can help you decide which options are more profitable than others. Let's take a look at some profitability estimates. So we're going to jump to a chart on General Motors stock. The last price in this particular case of General Motors was $26.73. These option strikes are options with ongoing transactions. There are no option strikes here listed that have zero interest or zero volume. So as you can see, at the $18 strike price, if we were to buy it at 18 and sell it at 18 just by buying the stock, you would have zero profit. And according to this chart, as you might guess, the highest sell price is 30, the lowest buy price is 18, that would $12 profit if we bought this stock and sold it at the appropriate time, just based on the opportunities on this chart. Let's take a look at the dollar gain here. So looking at that same transaction, buy it at 18, sell it at 30, we would have a 67% gain on that transaction. Anything other than that gives us a lower profit. In fact, in some cases, we have a negative profit. We bought the stock at $28 and sold it at $26, we'd have a 7% loss. That's important to know about percentages of losses or gains. We'll take a look now at what happens when we do an option. So here's calculating the best long call option strikes. We do this by looking at the percentage gain for that option. So here's a spreadsheet. As we look this over, here's our $18 strike, our $30 eventuality. Isn't it interesting? Compared to our 67% of merely buying and selling the stock, the option only gives us 35% if we did that same transaction. And yet, in this case, it's the $27 strike that gives us 119% rate of return on the option. It's almost double what we'd get if we just bought and sold the stock. That's why options are so popular, as we talked about in the last chapter. We get a much better leverage with options. Let's take a look at the put. Once again, these are the strikes that have volume. None of the strikes without volume were listed. But if we bought the $25.50 strike and sold it at $24, we'd have a 400% gain. It just turns out, however, based on the price of these options, the most profitable option is the $26 strike. Buy the $26 strike. When the stock price gets to 24, we maximize our profit. As you know, with a call, we profit when the stock price goes up. With the call, we profit when the stock price goes down. So if we had bought the $26 option, waited until the stock price got to $24, we would maximize our profit. Interesting, huh? So, how can we incorporate these concepts in our plan? I would suggest that you have a spreadsheet that you determine, that you create on your own, or you may look for the one on our website, www.academyoftI.org, which is Academy of Trading and Investing. You will find some spreadsheets there that you're welcome to use if you are a signed up member of Academy of Trading and Investing. So let's continue to build our rules. What do we want to incorporate when we are exercising or using options? Once again, this is Paul Gibson with the Academy of Trading and Investing. There will be many opportunities in the future. If you would like to be prepared, let's get educated now. We challenge you to get involved. If you'd like help with study on these concepts, please give us a contact at www.academyoftI.org. We're here to help. There are coaches standing by with some availability in their schedules to be able to help you understand these concepts and implement these concepts and start making money more efficiently and more quickly than if you try to struggle through this on your own. You could do that. But if it seems daunting or would you like some help, we're here to help. Once again, these are concepts from Notes from a Profitable Investor, how to adjust the stock market in your spare time. And of course, this is also available on Amazon Prime and Kindle. We'll look forward to talking to you in our next lesson.